Many people want to grow their money. They dream of financial security and a comfortable future. They want their money to work for them. This is called investing. Investing can seem complicated with so many options and risks involved, but it doesn't have to be. With the right guidance and tools, anyone can start investing. Mutual funds are a good way to start investing. They offer a simple and accessible entry point for new investors. They are popular because they are simple and can be less risky compared to picking individual stocks. Mutual funds are a way to pool your money with other investors. This collective approach has many benefits. You pool your money with other investors, which allows you to access a broader range of investments. This allows you to invest in a variety of stocks and bonds, spreading out the risk. You don't have to pick individual stocks yourself, which can be time-consuming and stressful. This makes investing easier for beginners who might not have the expertise or time to manage their own portfolios. Mutual funds are managed by professionals. These experts have the knowledge and experience to make informed investment decisions. These professionals pick the stocks and bonds in the fund, ensuring a balanced and diversified portfolio. They make sure the fund is invested wisely, constantly monitoring and adjusting the investments as needed. This gives you peace of mind, knowing that your investments are being handled by experts. You know your money is in good hands, and you can focus on other aspects of your life. Mutual funds are a good option for long-term growth. They can help you build wealth steadily over time. They can help you reach your financial goals, whether it's saving for retirement, a child's education, or a dream vacation. Let's learn more about mutual funds. Understanding how they work can empower you to make better financial decisions. We will see how they can help you build wealth and achieve financial success. Imagine a big basket. This basket is a mutual fund. Inside the basket are many different fruits. Each fruit represents a different company's stock or bond. When you invest in a mutual fund, you are buying a piece of this basket. You own a share of all the fruits in the basket. This is called diversification. Diversification is important because it spreads out your risk. If one fruit goes bad, you still have all the other fruits. Mutual funds are like baskets of investments. They allow you to own a small piece of many different companies. This makes them less risky than buying individual stocks. Mutual funds are easy to buy and sell. You can buy them through banks, brokers, or directly from mutual fund companies. This makes them accessible to everyone. Mutual funds offer several benefits for investors. One key benefit is diversification. Diversification helps to reduce risk. When you invest in a mutual fund, your money is spread across many different stocks or bonds. This means that if one investment does poorly, the others can help to offset those losses. Diversification is like having a safety net for your investments. It helps to protect your money from big losses. Another benefit is professional management. When you invest in a mutual fund, your money is managed by a team of experts. These experts have years of experience in the financial markets. They use their knowledge to select the best investments for the fund. This takes the guesswork out of investing for you. Don't put all your eggs in one basket. This is a common saying in investing. It emphasizes the importance of spreading your investments to manage risk. It means you should not put all your money in one investment. Concentrating your funds in one place can be risky. Diversification is key to reducing risk. By spreading your investments across various assets, you can protect yourself from significant losses. Mutual funds make diversification easy. They pool money from many investors to buy a wide range of assets. They invest in a wide range of assets. This could include stocks, bonds, and other securities. This variety helps to balance the risk. By investing in a variety of assets, you can reduce the impact of any one investment on your overall portfolio. This strategy helps to smooth out the volatility. For example, if you invest all your money in a single stock and that company goes bankrupt, you could lose everything. The risk is concentrated. However, if you invest in a mutual fund that holds stocks from many different companies, the impact of one company going bankrupt is much smaller. The risk is spread out. Diversification is especially important for long-term investors. It helps to manage the ups and downs of the market over time. Over time, markets go up and down. This fluctuation is a normal part of investing. By diversifying, you can ride out the ups and downs and come out ahead in the long run. A well-diversified portfolio can provide more stable returns over time. Section 5. Professional management. Another key benefit of mutual funds is professional management. When you invest in a mutual fund, you are essentially hiring a team of experts to manage your money. These experts are called portfolio managers. Portfolio managers have years of experience in the financial markets. They use their knowledge and expertise to select the best investments for the fund. They also monitor the fund's performance and make adjustments as needed. Professional management can be especially beneficial for investors who don't have the time or expertise to manage their own investments. It allows you to relax and let the experts handle the details. Section 6. Different types of mutual funds. In this section, we will explore the various mutual fund options available to investors, each with its unique characteristics and benefits. There are many different types of mutual funds available to investors, each catering to different investment goals and risk appetites. Some funds invest in stocks, aiming for capital appreciation, while others invest in bonds, focusing on generating steady income. Some funds focus on specific sectors such as technology or healthcare, allowing investors to target industries they believe will perform well. Equity funds invest in stocks, providing an opportunity for significant growth. They offer the potential for high growth, but they also come with higher risk, making them suitable for investors with a higher risk tolerance. Bond funds invest in bonds, which are essentially loans made to corporations or governments. They offer lower growth potential than equity funds, but they are also less risky, providing a more stable investment option. Index funds are a type of mutual fund that tracks a specific market index, such as the S&P 500, offering broad market exposure. Index funds are passively managed, which means they don't try to beat the market, but rather aim to replicate its performance. Instead, they simply aim to match the performance of the index they track, making them a cost-effective investment option. Target date funds are a type of mutual fund that is designed for investors who are saving for retirement, with a specific target date in mind. Target date funds automatically adjust their asset allocation as you get closer to retirement, gradually shifting from higher risk investments to more conservative ones. This helps to ensure that your investments are appropriately allocated for your time horizon, providing a balanced approach to retirement savings. Section 7. How mutual funds work. When you invest in a mutual fund, you are buying shares of the fund. The price of a mutual fund share is called the net asset value, or NAV. The NAV is calculated by dividing the total value of the fund's assets by the number of shares outstanding. Mutual funds charge fees for their services. These fees are called expense ratios. The expense ratio is expressed as a percentage of the fund's assets. For example, if a mutual fund has an expense ratio of 1%, this means that you will pay $1 in fees for every $100 you invest in the fund. When you sell your mutual fund shares, you will receive the current NAV per share. The NAV will fluctuate based on the performance of the underlying investments in the fund. Section 8. Time and patience in mutual fund investing. Mutual fund investing is a long-term game. It's important to be patient and not get discouraged by short-term fluctuations up and down in cycles. Over the long term, by investing in mutual funds and staying invested for the long term, you can benefit from the power of compound growth. Compound growth is the process of earning interest on your interest. Over time, even small amounts of money can grow to significant sums thanks to the power of compounding. Section 9. Starting your mutual fund journey. Starting your mutual fund journey is easier than you might think. You can open an account with a brokerage firm or a mutual fund company. Once you have an account, you can choose from a wide variety of mutual funds. When selecting mutual funds, it's important to consider your investment goals, time horizon, and risk tolerance. If you are saving for retirement, you may want to choose a target date fund. If you are looking for high growth potential, you may want to choose an equity fund. It's also important to diversify your investments. Don't put all your eggs in one basket. Instead, spread your money across a variety of different mutual funds. Section 10. Research and financial advice. Before investing in any mutual fund, it's important to do your research. Read the fund's prospectus carefully. The prospectus is a document that provides detailed information about the fund, including its investment objectives, fees, and risks. If you are unsure about which mutual funds to invest in, you may want to consult with a financial advisor. A financial advisor can help you create a personalized investment plan that meets your specific needs and goals. Remember, investing involves risk. The value of your investments can go up or down. It's important to invest for the long term and to be prepared for market fluctuations. Section 11. Conclusion. Start small, dream big. Mutual funds offer a simple and effective way to invest in the stock market. They provide diversification, professional management, and affordability. By investing in mutual funds and staying invested for the long term, you can build wealth and achieve your financial goals. Remember to start small, do your research, and seek professional advice when needed. Investing is a journey, not a sprint. By taking a disciplined and patient approach, you can grow your wealth over time and secure your financial future.